Everyone, my name is Spencer Clausen. I am the CEO of Worth Unlimited, and we welcome you to this evening's call, our opportunity call for Worth Unlimited. We are so very excited to be having this call. You know, we are making great strides and progress in the corporate office. We have an extreme amount of enthusiasm. We're feeling it in the field. We've been very busy in the last week or so with calls and efforts that all of you are creating, at least you agents. And so we welcome our agents on the call this evening, as well as prospective agents. We extend a special shout out to each one of you for joining us this evening and to allow us to introduce to you the Worth account and your opportunity to be an agent with Worth Unlimited. Joining us on the call this evening are our founders, John Washenko and Skylar Whitman. And we're going to turn the time over to Jason Brown. We introduced Jason last week. He is phenomenal. We're so grateful to have him as part of the team as our VP of Sales and Marketing. He comes to us with incredible background in having worked in the field and having the experience that each one of you can participate in and enjoy the fruits of. He's got great experience with the Worth account, and we really value his addition to the corporate team. We know that those of you who participated on last week's call really enjoyed his messages. Today, let me just give you a quick note, a reminder. If you go into the back office, we did post notes and the announcements from last week's call up there, and we have some really, really great information this evening and exciting new stuff that Jason is going to present this evening. So we'll turn the time over to Jason, and again, we are grateful and thank all of you for joining us this evening. So Jason, take it away.
Okay, thanks a lot, Spence. And I know some people are typing in already and saying, make sure you're recording this call. This call is being recorded, and this will be posted in the back office. So, guys, what an exciting time. I'll tell you, things are exploding and growing, and you're in that beginning stage when we do a call last week and we get tons of feedback and excitement, and then there's twice as many people on the call this week. So that's exciting. I mean, if it grew by 100% a week, who knows where we'd be a year from now. So, well, guys, I know we have people from all over the country on the call today, and some of you are already involved as an agent with Worth Unlimited, and some of you are taking a look at this for the first time and seeing if this is an opportunity that you might want to get involved with. And so what we're going to do in this call is I'm going to talk to you a little bit about the Worth account and kind of explain how the product works. Now, this presentation I'm going to show is short, but it kind of delves into the product and shows how interest cancellation works. Some of the feedback we got after last week's call was, man, that presentation is awesome, but I don't think I could ever give it. Well, that's the beauty, is you never have to give this presentation you're getting ready to see. So I'm going to go through and show you how the product works and help you really get your mind wrapped around how people are getting their home and other debt paid off so quickly using our program. And again, keep in mind as I'm going through this presentation, this is just so you understand what the product is. You don't ever have to sell it. You don't have to give this presentation. But after that, we'll go through the details of how you make money selling the program, and then we've got some pretty exciting announcements to add that I know a lot of you are excited to hear. So, guys, the Worth account, where do we come from? Our background is in the mortgage industry. We started in the late 90s, and we were one of the fastest growing companies. We have one of the fastest growing companies in the state of Utah. Very successful. But early on in business, we started to see a lot of repeat customers. And in most industries, that's a good thing, right? Repeat business. But in the mortgage industry, when somebody's coming back to refinance their home every other year or every third year, it's usually not because they're in a good situation, but because they've accumulated what? Debt. And they have to use the equity in their home to keep their head above water. And of course, that goal of actually getting their home paid off gets further and further away until it becomes pretty much non-existent. And so in the early 2000s, we heard about a concept that was being used in Australia and parts of Europe that would take a mortgage, cut it in 1/2 to 1/3 the time with the same income that the homeowner already had, so they didn't have to go get a second job or make more money. We spent a couple of years in research and development, and we took that concept from Australia and and converted it to the way that U.S. banks and lenders charge interest on homes, and developed it into a software program that takes the homeowner by the hand and walks them through how to do it. Guys, that's probably the best part about what you're getting ready to see over the next 25, 30 minutes is you don't have to be a mortgage expert. You don't have to understand interest or Excel spreadsheets or finances for the program to work for you. If you can log onto the internet and use a mouse, it's point and click. And so we had the finished product in 2005. We didn't want to just throw it out there and start selling it. We wanted to test it first. So we chose Denver, Colorado for a test market, and we sold the product to about 400 homeowners. After using the product for about a year, year and a half, the average client was already 20% ahead of their projected payoff. So if they bought the program and they have a 30-year mortgage, we were going to get them paid off in 10 years. After 1 year, they were already 20% ahead of that schedule. And you'll see, as I go through this presentation, the product starts to instill a discipline in you. And it's almost an unconscious discipline, and you'll see what I mean by that. So, guys, over the few years after that, it just exploded across the country. We grew from again, just relatively small in numbers to tens of thousands of people across the country using the program. Again, in 2008, I'm sure you've heard of Ernst & Young, one of the largest financial service firms in the world. Every year they come out with an Entrepreneur of the Year award, and it's a pretty prestigious thing. They have different categories, one of which is financial services, and in 2008, the founders of the company received the Ernst & Young Entrepreneur of the Year award. So we're now launching Worth Unlimited, and again, our track record kind of speaks for itself, and the opportunity is brand new. It's kind of a unique situation because we've done this once before. The economy changed where at one time we needed a line of credit to use our program. So the program we had to make some adjustments on it, and the field force actually switched over to another company. We now have the Worth Unlimited. The product is better than ever, and we're looking to relaunch the opportunity that we built once already. So, the main question people get is when you talk about the program, wow, I have this program that's going to pay my home off in, from 27 years left on my mortgage down to 8 or 9 years. The first question people say is, well, how? How does that work? And that's what we're going to go over today. But the program, when it first got launched, it only worked on a mortgage. And if you had other debt that you wanted to pay off, you actually had to roll it into your mortgage. It's not that way anymore. Now the version that we're going to show you today actually works on everything: credit cards, vehicles, student loans, hospital bills, any type of debt. And then the third goal of our company is to educate you about the program. We provide you with coaching, and now the latest version actually has some wealth education and tracks your net worth and some exciting things like that. But we're going to start off with number one. Guys, my background's in the mortgage industry, and when I took a look at this program for the first time, it just made sense to me because most people, and again, maybe you guys on the phone are the exception to the rule, but most people, what do they understand or know about their mortgage? Not a whole heck of a lot. In fact, if anybody has any mortgage experience on the phone, they'll tell you that when most people, when they're going to sign the paperwork on a loan, they want to know two things before they agree to the mortgage: rate and payment. And that's it. I know my interest rate and my monthly payment, and I'm good. So I'm going to give you a 30-second mortgage basics class here. So guys, let's just take a $200,000 mortgage at a 6% interest rate. Over 30 years, which is 360 payments, the monthly payment's $1199.10. Now that's the actual payment for these terms. So month one, we send in our payment, $1199.10. $199 of that payment goes to principal. $1,000 goes where? Interest. Okay. Month two, $200 of our payment goes to principal. $999 to interest. So we just increased the principal portion of our house payment by $1. We're really pounding down that mortgage, right? After 1 year, guys, check this out. We made $14,000 in house payments to pay down the principal of the home, $2,400. Let me ask you a question. Let's say you buy a home today for $200,000, and 5 years from now you sell it for $250,000. How do you feel you did? Now, most people are going to say, I did okay, not too bad, could have been worse, right? Well, let's look. 5 years into the loan, we've made $71,000 in house payments and paid down the principal of the loan by $13,000. Guys, if you sold that house for $250,000, what just happened? You lost money in that situation, okay? Some people think after the 15th year on a 30-year mortgage, you're what? Halfway there? Well, guys, it's actually 21 years into a 30-year loan. We've made $300,000 in house payments, so we paid for the house 1.5 times over, and how much do we still owe? We still owe $100,000. It's not till the 21st through 30th year that we actually have more of our house payment going to principal than we do to interest on a monthly basis. Now, guys, when you signed your mortgage, one of the documents you had to sign was called the Truth in Lending Statement. And that tells you how much you're actually going to pay back over that 30-year term. On a $200,000 mortgage at 6%, you'll pay back $431,677. Guys, a little while back, I was presenting this to a gentleman, older guy, real funny guy, kind of king of the one-liners, and he said, yeah, but my wife always wanted a $400,000 house. Well, guys, and this is loan amortization. You can plug in any amortization calculator and see how these numbers ring true. And, guys, it's just at a point where it's almost impossible for the average person to get ahead on this type of system. And it obviously was not put in place to benefit you, the homeowner, even though this is probably the largest investment that we'll make in our lifetime is our home. So let me show you how the Worth program works. Let's pretend that in month 1 of that loan, now this is a big pretend here, we're gonna pretend that we could afford to add $5,000 to the payment. Not every month, just 1 month. All right, so we send in $61.99 that first month. Let's see how that affects our loan. We get our statement in the mail the next month, and we now owe $195,000. So it worked, didn't it? It knocked $5,000 off the principal. Now, did our interest rate change? Nope, still 6%. Did our monthly payment change? Nope, we still have to pay $11.99 a month. Now, we were scheduled to pay for 360 months on that mortgage, right? Well, guys, take a look at that. That one $5,000 principal payment just canceled 23 months or 2 years payments off our loan instantly. Now, the interest we were scheduled to pay was $231,677. Remember, we were going to pay $431,000 for the home. That one $5,000 principal payment just canceled $28,304 of scheduled interest off the loan. Even if we don't count the $5,000 that we sent in, that principal payment, it's still a net savings of $23,304. And guys, that's guaranteed, and it's instantly. The minute you send in $5,000 on a $200,000 mortgage at 6%, you save 2 years worth of house payments and $23,000 in interest. Now, I realize this looks good on paper, right? But there is one problem with this in real life. Who has $5,000, right? And even if you did have $5,000, you're probably not going to send it in on your mortgage, because what if you need it? All right, you can't get it back. Actually, there is one way to get it back: refinance, cash out, refi, lose the $23,000 in interest savings, and start the whole process over. But again, guys, this is not the Worth account. But this is the system that we use. I just wanted to show you how a lump sum payment affects not only the time you pay on your home, but also the amount of interest you're going to pay. So do me a favor, put this example in the back of your mind. I'm going to refer back to it here in just a few minutes. Now, there's several different ways to follow our program. I think I mentioned earlier on the call that when we first launched the program, it only worked with a home equity line of credit. Which is okay, because back in 06, 05, 06, 07, everybody could get home equity lines, right? I mean, if you could fog a mirror, you qualify for a home equity line of credit. Well, what are home equity lines like today? They're difficult to get. In fact, they're almost non-existent. And so, guys, over the years, we've worked and tweaked the software to now where it will work with any type of credit line. But what we're most excited about is that the program works just using a checking and a savings account. Now guys, probably 90-95% of the people that get on our program today are doing it just using their checking and their savings account. But for me to help you get your mind wrapped around the concept of interest cancellation and how the program works, I'm going to show you how it works using a home equity line. And then right at the end, I'm going to show you how it works using a checking and a savings account, and it'll be very simple to understand. So, guys, let's take that same mortgage. We have $200,000 at 6% interest rate, a 30-year term. And let's say we can qualify for a line of credit, and I call it an ALOC, advanced line of credit. But let's say we can qualify for a $10,000 line of credit. One of the things you've got to understand first off is how we use the line of credit. We're going to use it just like our primary checking account. In other words, we're going to pay all of our bills directly out of the line of credit. So as we pull money out and make our house payment, car payment, cell phone, groceries, utilities, entertainment, the balance on this account starts to go up, right? Are you with me? But as soon as we get our paycheck, we deposit it against that balance and it drops right back down. Now, every time the balance on that line of credit gets close to zero, the Worth account software is going to kick in and prompt you to do what's called a funds transfer. You're going to hear me use that a lot over the next 15 minutes. A funds transfer is when it tells us to pull a sum of money from the line of credit and send it over to the principal on the first mortgage. Now this example is prompting us to do a funds transfer of $5,000. We just hop online, move $5,000 from the line of credit, send it over to the mortgage. Guys, think back. What does $5,000 do to a $200,000 mortgage at 6%? We just knocked 2 years' payments and $23,000 in interest off of this loan instantly. Now, when I saw this the first time, I said, yeah, but you still owe $5,000 over here. All you guys did was create one debt to pay off another. Guys, when we run your analysis and tell you that your home's paid off in 7, 10, 12 years, not only is your first mortgage paid off, but so is the line of credit. They're both at zero. We don't create one debt to pay off another. How does the balance on the line of credit get paid off? Because we're using this like our checking account. So we're depositing our income into this balance throughout the month. Guys, it might take us 2 or 3 months to get the balance paid back down close to zero. But as soon as it gets close to zero, what happens? The software kicks in and prompts us to do another funds transfer. So the balance on the line of credit goes back up a little bit. It takes us 2, 3 months to get it paid back down. As soon as it gets paid back down close to zero, what happens? It does it again. And so this first mortgage starts to get hammered down by big chunks every 3 or 4 months, while the line of credit just kind of goes up and down, and hovers right near zero. Now, guys, hopefully you're starting to get the concept. But what I'm going to do is I'm going to take a sample family, and I'm going to run through a monthly scenario to really help this sink in. Let's say that we make $5,000 a month in income, and then we have $4,000 a month in bills. Now, that's everything, guys. House payment, car payment, cell phone, all our expenses. That leaves us $1,000 of discretionary income at the end of the month, and yes, I realize that's not the typical American budget to have $1,000 left over every month. I'm just going to use these round numbers to show you the concept. Guys, the program works if somebody has $20 or $50 a month of discretionary income. But so again, I'm going to use these round numbers. So the first thing we're going to do in month 1 is we're going to buy the software. Now, guys, the cost of the Worth account now actually depends on how much we're going to save the client. So it could be anywhere from $750 up to $3,500, actually $3,495. So I'm going to kind of go worst case scenario, and we're saving the client several $100,000 in interest. So the program is $3,500. That's the first thing they're going to pay out of their line of credit. So we're going to start in this example with a balance on our credit line of $3,500. Well, it's the first of the month. What do we got to do? We got to pay bills. So our house payment and groceries and all that stuff comes out of the line of credit, our car payment. So now we owe $7,500 on our line of credit, which is like our checking account. But we get paid throughout the month, right? So we deposit our paycheck against that balance. It lowers the balance owed on the line of credit to $2,500. Guys, lines of credit are open-ended, which means even though we used $7,500 out of the line of credit, the bank can only charge us interest on the $2,500. Lines of credit interest rates right now are like 2, 3, 4%. I'm going to, again, trying to go as conservative as I can, I'm going to say we have a 10% interest rate. 10% times 2,500 divided by 12, the interest charge for the month would be $20.83. Now, we never send in $20.83 because we sent in $5,000. The bank took that as a payment. Now, did they take the $20 out of the $5,000? Sure they did. But it, again, is not another $20 check that we have to send in to the bank. So we're going to take the $2,500 over to the next month, and we're just going to continue living our life as normal. We're keeping our income and expenses the same, so the balance on the line of credit goes up to $6,500 after we pay our bills and down to $1,500 after we deposit our income. Finance charge for the month is $12.50. Let's carry the next $1,500 over to month 3. We spend $4,000 in living expenses. That takes us to $5,500. Don't forget, guys, that includes the house payment. We still have to make that every month. We deposit our income against that balance, and guys, we're down to $500. I know I'm throwing a lot of numbers at you, but as you can see, the balance on the line of credit is almost down to zero. We only owe $500. What's getting ready to happen? The software kicks in and prompts us to do a funds transfer. The software said, okay, let's move $3,675.77 from the credit line and send it over to the mortgage. So what happens to the line of credit? Look at that. It went right back up to $4,100. That's what we paid interest on for $34. Guys, we've been on the program for 3 months. We paid a total of $68.13 in interest on the credit line over a 3-month time frame. But let me ask you a question. When we moved that $3,600 from the line of credit and sent it over to the mortgage, what part of the mortgage did it go? It went directly to principal because we already made the house payment. We already paid all the interest for the month. So the entire thing went right to principal. And guys, on a $200,000 mortgage at 6%, it just canceled $17,249 of scheduled interest off our loan, which is 18 house payments canceled, gone, that we will never have to make. If we look at the amortization schedule again, guys, we started at 360 months. We're down to 339. The principal, and we're only 3 months in, the principal portion of our house payment, if you guys remember, was increasing at $1 a month. Well, from month 3 to month 4, it jumped ahead $19. So guys, some people say, well, big deal, $19. Do you realize how long it would have taken you of making your monthly house payment to get to the point where you had an extra $19 going to principal? It would have taken you a year and a half. And we owe $195.7 on the mortgage. So here's what we owe on our line of credit, $41.75. We're going to carry that over to month 4 and just continue living our life, guys. So $4,000 goes out in expenses, $5,000 in. The line of credit is going to start to get paid back down by our again, just our lifestyle. Our discretionary income is paying down the balance on the line of credit, and it's costing us $25, $20 a month in interest on the credit line. Month 6, we're at $2,000, depositing or spending $4, depositing $5. The line of credit is back down to $1,000. We're getting close to zero again. What's getting ready to happen? The software kicks in and prompts us to do another funds transfer. This time it told us to move $2,920.23. Let me ask you a question, guys. Does the software make you guess how much to move? No, it tells you to the penny for your situation. And it's different for everybody. It actually the math reconfigures with every transaction. So that $2,920 goes straight to principal on the loan because we already made the house payment, and it cancels another $12,200 in scheduled interest and another 16 house payments off the mortgage. So guys, if we kind of do a 6-month look back, we've paid $146 in interest on the credit line over a 6-month time frame to cancel $29,500 in scheduled interest off the loan, which is 37 house payments that we'll never have to make. Okay? If we look at the amortization schedule again, we're down to 323 months remaining. Remember, we started at $360. The principal portion of the house payment increased again another $15. And guys, I don't know if you can tell, but this whole process starts to get addicting to you as a homeowner. I have people that I put on this program 3, 4, 5 years ago that still call me or email me once a year, once every other year, just to tell me where they're at on their payoff. And I have one lady from my hometown in Colorado that actually looks forward to getting her mortgage statement in the mail because she can't wait to see how much principal is been paid down each month. And guys, we owe $192,000 on the mortgage. So we're 6 months in. We've paid $8,000 in principal down on the first mortgage. Hopefully you're starting to get the concept. I'm going to go ahead and just jump up to the end of the year. As you can see, the balance on the line of credit is starting to get paid back down again. Month 9, it's back down to $1,000. Here comes another funds transfer. I'm going to go ahead and skip to the end of the year. Guys, let me point out one thing actually in month 11. You know, I know we're making it look good on paper here because we're keeping our income and expenses the same. Does that ever happen in real life? No. Income might stay the same for some people. What about expenses? They're all over the board. Now, I'm sure no one on this call has ever done this before, but let's say in month 11 we actually spent more than we made, okay? So we made $5,000 but spent, I don't know, $6,000. In real life, if you do that, what happens to you? Well, that money had to come from somewhere. You're either overdrawn if you didn't have any, or you got credit card, or you had to dip into savings. Well, guys, on our program, as soon as you overspend, the software sees it and makes a reaction. Chances are we were going to do a funds transfer next month, right? We might actually still do it. It's just going to be a smaller amount. Or if we really overspend, that funds transfer might get pushed back another couple weeks or another month until that line of credit, till we've deposited another check in there and the line of credit's down to that optimal transfer point. Now, don't get me wrong, I'm not saying you can overspend every month, but if it happens one month here or there, it doesn't completely throw you off, okay? So month 12, we're back down to that 1,000. We know what's coming, the funds transfer. Again, it does not make you guess how much to move. It tells you to the penny and the day to do it. That goes right to principal on the mortgage, cancels another $10,000 in scheduled interest, which is another 14 house payments gone. So wrapping up 1 year, guys, we've paid $297 in interest on the credit line over the course of 1 year. We've canceled $50,800 of scheduled interest off the loan in 1 year. That is money that we were going to have to pay on the loan that we don't now. That's 53 house payments. Now, guys, so you can go ahead and take your amortization schedule, take the last 53 payments, tear them off, and throw them away. You'll never have to make them. Because, guys, let me ask you, even if you stop using the program at this point, do you ever have to make those 53 payments? No, they're gone. Okay, you never have to make them. So, again, last look at the amortization schedule. We're down to 295 months remaining, 1 year in. The principal portion of our house payment increased by $75 over the course of the year. So not only are we paying it off faster on the back end by canceling principal and interest, we're paying it off faster on the front end as well because more of our house payments go into principal. And we owe $184,000 on the loan. So again, we paid down the principal of the loan over $15,000 in 1 year. If we'd just been making our regularly scheduled mortgage payment, we'd still owe $197,500 on the loan. It would take us 5.5 years of making our regularly scheduled payment to accomplish the same thing we did in 1 year using the Worth account. We're paid off in 10.4 years in this example, which saves us about $161,000 in interest. Now, guys, this is a $200,000 loan. When you start looking at loans of $200,000, $300,000, $400,000, that the interest savings becomes $300,000, $400,000, $500,000. So, hopefully you're starting to get the concept of how it works on a loan. I just want to show you what the software actually looks like and give you a sneak peek. Across the top is our dashboard. In one window, we have the years to pay off, which in my opinion is the most addicting window of all, okay? Because it's constantly changing. Every time you make a transaction, the software reconfigures itself. So as you're pulling money out and spending it, what's happening to that number? It's going up. But as you put money in, as you deposit money, that number starts to drop. Again, there's about 10 other windows that you can choose from. If you hit this plus button, it brings up if you'd rather see, interest paid versus interest saved, or, you can go in here and, years canceled. You can see all those different options. Guys, one of my favorite features is the software allows you to, let's say we're at 9.3 years to go and we want to take a vacation or make a purchase. Let's say we're going to take a trip and we're going to spend $2,500. We just come into our software before we go, say add a new action, and tell it we're going to spend $2,500 on a vacation. And the software will reconfigure and tell us how much time that's going to add to our payoff, how much extra interest it's going to cost, and in other words, it tells us exactly the true cost of the program. So a couple things, guys, and we're running a little short on time, so I'm gonna speed it up just a little bit, but it does show you that true cost live transaction update. So, this is one of the differences of the old version. If you go to the grocery store and you swipe your credit or debit card, by that night, it shows up executed already in your software. You don't have to manually go in there and put it in there. But the software, again, it just needs to know two things: how much money's coming in and how much money's going out, and it does the rest for you. Okay, guys, in just 3 years, our program had paid down over $400 million in mortgage principal. And I know, again, when you look at the mortgage debt in our country, that is just not even a drop in the bucket. But that number's growing exponentially, and so we're on a crusade to make that number double and triple and quadruple in the next couple of years. Now, how does it work on other debt? Again, people say, okay, I get it. How does it work on, I get how it works on my mortgage, but look, I've got credit cards and student loans and hospital bills and car loans. And guys, it's funny because every debt expert out there has their version of how you should pay this down, right? You guys have all heard of Dave Ramsey. He's got a great program, but Dave says, look, you should take all your extra money, if this is your K, if this is you need to take all your extra money and put it on this debt right here. Why is that? Well, because it's the lowest balance and it's going to pay off the fastest. And then you go to this one, and then you go to this one. Well, then John Commuta and also Susie Orman, they would tell you, no, take your extra money and put it here, because it has the highest interest rate and it's going to save you the most money getting rid of this debt first. Guys, those are good programs because they at least get you doing something, but they're not mathematically the fastest way to zero. There's just no way that a system like that can keep up with our software. Our program looks at every single characteristic of each debt. How much do you owe? What's the term? Is it a 5-year loan, 10-year, 30-year? It does look at the interest rate. How's the minimum monthly payment calculated, and when is it due? And of course, how many of you ever had a loan that started out at a low introductory rate and then changed on you over a short period of time, right? The software reacts to each one of these variables and guides you mathematically the fastest way to zero. So guys, wrapping it up, again, just to review the whole thing and kind of sum up what we've talked about, we have a checking account open and a line of credit. Now, we just paid bills, so the balance on our line of credit's up a little bit. Income comes in, let's say we have direct deposit, goes right into our checking account. We hop online that day and roll the balance over into the line of credit, and the balance decreases. Next month, exact same thing. Income comes in, we roll it into the line of credit. It took us a couple months, but we got the line of credit paid down. We're at the optimal transfer point. We know what's getting ready to happen, right? A funds transfer. The software tells us exactly when to do it, how much to move, but check this out. We have other debts, not just the mortgage. So in the beginning, that funds transfer may not go to the mortgage. It might go to one of the other debts. So in this example, it goes to the motorcycle. Well, 2 or 3 more funds transfers and that motorcycle is what? Paid off. And that $200 a month motorcycle payment is now more discretionary income. And guys, with more discretionary income, the funds transfers get bigger and more often. So the next month, it might go to the motorcycle, it might go, or the next funds transfer might go to one of the other debts. The software always tells you exactly where to move it to. Okay. Now again, I mentioned early on that most people don't have lines of credit, and they're using our program with just a checking and savings. What the software is going to do is it's going to look and see what you have. If you have lines of credit or not, the program is going to automatically prompt you the best way for your situation. With a checking and savings account, the first thing the program is going to have you come in and do is set a minimum reserve. It's going to say, okay, how much do you always want in these accounts? So let's say we tell it $500 in our checking account and $5,000 in our savings account. The program is never going to prompt you to move money below the reserve that you've set. Now, we told it we want $5,000 here. What if we don't have $5,000? What's it going to do? It's going to build it first. It's going to build up those savings for us as well, and then start working on the debt. So guys, how does it work? It works the same way. Income comes into checking. Now, we don't have a line of credit to pay our expenses with, right? So we have to pay it with our own money. Now, we might pay it with a credit card and then pay it off, but that money has to come out of a checking account. The discretionary income, whatever's left over, was it that $1,000, that $500, that $250, whatever it is, the software is going to move it over into the savings account in an interest-bearing account. Next month, same thing. Income comes into checking. We pay our bills. That discretionary income, that $500, that $1,000 gets kicked over into savings. So guys, you remember on the line of credit, the discretionary income was paying down the balance on the line of credit. Well, it's just the opposite. In the savings account, it's just building a balance. So in the same amount of time it would have taken you to pay down the balance on a credit line, we've built enough money in a savings account to do what? A transfer. So the software kicks in, tells us the day to do it, the amount to move, and again, to which debt to send that funds transfer to. And guys, some people, in fact, a lot of people, when they see the presentation, they say, gosh, so you can use it with a checking and savings account. How does the payoff compare? If we had a 30-year mortgage and all the variables were the same, guys, the payoff is almost the exact same between the checking and the savings. Because, again, with a line between the checking and savings and using a line of credit. With the line of credit, you get to take advantage of interest float, but with a savings account, you're not having to pay that small interest charge every month, so it almost evens it out. And guys, the third goal of our program is, again, it's about wealth education, because the goal here is to help you get out of debt. But once you're out of debt, the potential of building wealth is so much greater. Now, if you had a 30-year loan and it got paid off in 10.4 years, that's 19.6 years that you were supposed to have a house payment. And so, guys, if for 19.6 years you took your house payment and your discretionary income and you continued to pay that, but instead of having to pay it on a debt, you put it into an investment. After 19.6 years, you'd have $1 million at 6%. Guys, that's in the same amount of time that you would have just been making your last house payment. And I'll end this portion of our presentation by just sharing one story with you. I had one client, when we run your client's analysis, when you refer someone over to the company, we not only show them when everything's going to be paid off, but we show them how much they could build in a wealth building account after they become debt free. And so I showed this gentleman, and he goes, well, Jason, what if I got my home paid off in 8 years, because he had 26 years left, and instead of putting the money into an investment, I bought another house. And so we took the software and we jumped ahead 8 years in the future. We freed up his next house payment, and we did not even include rental income, though. So we just had his current house payment and his future house payment, and the next home was paid off in just under 6 years. We did it again, freed up that second house payment, added a third mortgage. The next home was paid off in 5 years. We did it again. The next home was paid off in just under 5, about 4.5 years. Guys, in the same amount of time that it would have taken him to purchase one home on an amortization schedule, he's now got 4 paid for, free and clear, and 3 of them are income producing. So, guys, hopefully you see the potential of what the program can do. If you're seeing this for the first time, you got to realize too, you never have to give this presentation. I know it goes a little in depth into the software, but I want you to be able to get your mind wrapped around what our program does. And if you're seeing this for the first time, again, looking at this as an opportunity, what I'm going to do is I'm going to switch our PowerPoints here, and we're going to show you what type of opportunity there is and what kind of money you can make by becoming an agent with the Worth account. So give me 1 second here. Okay. Well, guys, when I saw this program for the first time, again, I was working full-time as a loan officer, and the program just made sense to me. And I said, gosh, I know I can get some people on this program. And so my first month, I showed the program to about 3 people, and 2 of them took advantage of it and became clients. And, guys, the craziest thing happened. Within a few weeks of them using the software, I started to get calls from them. Number 1, to thank me for the program, but number 2, to tell me their friends went on it, their neighbors went on it, their coworkers went on it. It was the first product that I had ever sold where people called me to give me referrals and to ask me, how can I get involved and how can I take advantage of this and show this to people I know, and is there an opportunity there for me? So again, there's probably you're thinking 1 or 2 things on at this point of the call. Is one is, wow, this program's amazing, I need to get on it and pay my own home off. The other thing is, geez, I know a ton of people I could get on this program. And so we're going to talk about what a Worth agent does. Now, in our past marketing campaign, guys, you had to not only invite people to look at the program, but you had to present it to them. You had to give the presentation that I just gave you. Okay, you had to present maybe a demo. You had to run their analysis. You had to close and answer any questions they had, and ultimately you had to collect payment on the program. Well, guys, if you look at this picture here, does this lady have a laptop or a whiteboard? Is she giving a presentation? Absolutely not. All you have to do is invite and refer. Guys, and the conversation is going to be something like this. Hey, John, I don't know what your mortgage situation or debt situation is, nor do I want to know, but I got to tell you, my wife and I, we found this incredible program. It's helping us pay our home off early. We have 27 years left on our mortgage, and it's going to get us paid off in 8.5 years. It's incredible. You've got to take a look at this thing. Well, chances are John's going to say, well, what is it? How does it work? What is it? You know what, John? I'm probably not the best person to explain this to you. But I'll tell you, it's kind of a financial GPS. It links up with your accounts and guides you how to have everything paid off. They're just great to work with. You got to take a look at it. Well, John's going to say, well, how much is it? Right? How much does it cost? Well, John, that's the best part. Their fee is based off of how much they're going to save you. So I've already referred a few people over to these guys. What they do is get on the phone with you. They run an analysis for you. So you tell them what you owe on your different debts, and the software calculates how much interest it's going to save you, when everything's paid off, and then, of course, how much it's going to cost. And then they help you get set up on the program. It's amazing. You ought to let me have these guys give you a call. Guys, when you're passionate about something and you're excited about something, referring it just comes natural. I mean, how many times have you gone to a movie and then gone and tell somebody about it, or ate at a good restaurant, or read a good book? And especially with a movie or a book, if you try and explain the movie or the book, people say, no, don't tell me. It's the same thing with this program. No, don't go into it. Don't tell them what it is. Because when they get referred to our home office, they get on the phone with an expert who knows our program inside and out. And we treat your client with kid gloves. We run their analysis for them, explain the program. We might show them a demo. It might even take 3 or 4 calls, however long it takes to get all their questions answered, and we get them set up on the program. Again, we took everything that was hard in our previous marketing model, and we took that out. So what does a Worth agent do? Again, direct people to the company to get a free Worth analysis and build a team that does the same. And guys, again, you're looking at this going, oh, wow, this is one of those things that I've got to go recruit. Absolutely not. If you don't want to recruit and you just want to refer people to get the Worth account analysis, you can do that. But I'm going to tell you, just like with me, people recruit themselves. And guys, again, I came into the last organization we had not wanting to recruit a soul, But both of those people my first month wanted to come on as agents. The next month I had a few more, and then their people started coming on as agents. And over the course of about 2.5 years, that grew to an organization of over 5,000 people. This thing, once people get excited about the program, it just starts to go viral. Viral in a good way. Okay, so, when these guys put together the compensation plan, guys, I was blown away the first time I saw it. They did a ton of market research. They took all the companies out there that are seeing the most explosion, and the agents are seeing the most income and most growth, and they stole the best parts of their compensation plan and put them in ours. So the first way we get paid is through personal sales. Now, we ought to just take the word sales out of it, because are you selling anything? No, you refer people to the home office and they sell the product for you. Now, when I was talking to one of our past agents in Colorado, she's a gal, had a few hundred group people in her organization in a leadership position, and I mentioned, hey, this new model, you don't have to sell, all you have to do is refer. And she says, well, how much is the referral that you get? And I said, well, it depends on what rank and how much volume it's turned into a month, but I said it's anywhere from $500 to $1,100. And there was silence on the other end of the line. She said, you mean I get paid $500 to $1,100 for referring someone? She goes, when you said referral, I thought you were going to tell me it was $50 or $75. And since our conversation last week, she has 3 people that she's already talked to that are calling in for their free analysis. Guys, one of the things that we understand is the most crucial time in your business is your first 60 days. Guys, if you get involved with an organization and you don't make any money or make very little money in the first 60 days, what are you going to do? Chances are you're going to quit. I know with me, my wife's going to tell me, Jason, you're not doing that anymore. You're not making any money. Okay? We realize you've got to come in here and make some money early on. And so for your first 60 days, in addition to that 15 to 30% on your personal referral, you're going to get an additional 5% during your first 60 days. Guys, we just cut a check to a gentleman last week for a referral that literally took him 5 minutes. He got a check for $699. When people get that first check, they start to get excited. The next thing is overrides. Okay, anyone you refer, you also receive an override on everything they sell, or they refer to the company that gets sold. But guys, when you recruit a new person, what is the most important time on their business? Their first 60 days as well. And who are they going to look to for help? Chances are they're going to look to you as a mentor. And so not only are we going to pay them an extra 5% on their first 60 days, but you as the mentor, the person who got them involved in the business, is also going to get that additional 5% on all of their production. And guys, if they were to introduce somebody to the company, so there's 2 levels away, you're going to get 3% on that new person's first 60 days. Guys, I'll tell you, our compensation plan is incredible. The leadership commissions and advancement bonuses and personal and team incentives. I mean, these guys are excited about some of the things that are rolling out in the next few months, competitions, trips, really cool stuff. So, but what I want to do is I want to introduce probably the most exciting part of the call is the bonus pools. And when these guys structured our compensation plan, they held portions of the revenue that was allocated for compensation to release in bonus pools. And guys, I'm going to tell you, bonus pools for me and our past organization were probably the most exciting thing about our compensation plan, because not only did you already get paid commission on the deal when you submitted it, at the end of the month, you got another check on top of that. So it was literally, it felt like free money. Okay? So a personal producer bonus pool. 3 personal referral activations in a month. So 3 of your personal referrals turn into sales in 1 month qualifies you for that pool. 2.5% of every sale company-wide is going to go into that pool. So not just your organization, the entire company. So that pool gets pretty good size, and then what happened is your share or shares get paid out according to dollar volume. So guys, if you came in and you had 3 sales that added up to $9,000, and I had 3 sales, but mine added up to $4,000, or to keep the math simple, let's say it was $4,500. then you would get double the share that I got on that pool. So that, that's the most fair way to do it. Shares get paid out monthly. Again, these are separate above and beyond the commission that you already got paid. And so I'm going to tell you what happens in you and your organization. When you've got 2 sales and there's 1 week left in the month, what do you think that does to you? You know that not only are you going to make a commission on that 3rd sale, but you're going to get a check at the end of the month for, again, who knows what these pools are going to get up to. I remember getting bonus pool checks of thousands of dollars at the end of the month. Another bonus pool, and this is exciting, is called the partner pool. Guys, the top position in our comp plan is now called partner. And guys, you hear the name partner, what does that mean? It is what it means. You're a partner with our company. And so that allows you 6.25% of every sale is company-wide is going to go in this pool. And guys, that allows you to override the entire organization, not just your company. So it's exciting. This is the first time I've seen any kind of company actually open up company revenues, because they want you to succeed. They want this to be a long-term goal and organization for you. Guys, some people, again, we kind of talked to a few people and consultants in the industry, and we talked about our partner bonus pool. And one of the things everybody was like, that is incredible. We've never seen that in the organization. What a great idea. Or the industry, what a great idea. But they said, what about, is it going to motivate people short term? Because that's the highest position in our company is with partner. So what if it takes you 1.5 years or 2 years to get there? And so, guys, the owners and Spence put their heads together, and they came up with a fast track to partner pool. Hopefully you're as excited about this as I am. There's a few announcements that come down the line every now and then that literally keep you awake at night, and this is one of them. They're going to allow you, if you reach executive director, which I'll show you the positions in just a second, in the first 6 months. So you've got 6 months to hit that position. They're actually going to allow you to participate in the partner pool. Now, not the entire thing. We're going to take 50% of that partner pool and allow people that hit executive director in their first 6 months to delve into that pool. And guys, hopefully you understand how big that's going to be. It's exciting. This promotion applies for all agents that sign up now through September 30th. And so as soon as they sign up, they have 6 months to hit that. Now, of course, we knew what was going to happen is everybody says, well, gosh, I signed up a month ago, so I've only got 5 months left, or I signed up 2 months ago. Already existing agents, guys, your 6 months start Monday the 6th. And guys, hopefully this literally has just turned your seat extra hot because you can't be sitting here. This hopefully gets you excited to go out and start talking to people and building your organization. I'm going to, again, tomorrow we're going to talk on the agent training call, more of the details about this, and how those bonus pools work. One of the questions that somebody typed in here was, well, how much does the product cost? Again, it's done on a percentage of the savings. So it can be anywhere from 0.5% to 3% of the savings of the product when we run their analysis. Guys, real quick, we're going to show you the income goal setter that Mr. John Washenko himself has put together. Now, guys, if you haven't got to know John a whole lot, he is, first of all, he's one of the masterminds behind building the actual software, but John is an Excel spreadsheet guru. And so when he took our compensation plan, because one thing I like, you can look at a compensation plan and see levels and percentages and, wow, that looks great. It sounds like you could make a lot of money, but John actually takes every one of those bonuses and compensation structures and plugs them into an Excel spreadsheet where we can go in and say, well, if we were referring this many people a week and this many of them were buying and we recruited this many agents, here's what our check would be. And so if you have access to this on our back office, guys, this is something, if you open it and start playing with it, you're going to be awake all night. So I'm going to ask a question. I know you guys can't answer this, so just answer it to yourself. If you got excited about this product and this opportunity, realistically, how many people in a week could you refer to the company? Now, I've done this in the past 2 weeks, guys. I've asked probably 25 people that question, and almost every single person goes, gosh, I don't know, 5 people, 1 a day, 10 people, 2 a day. Well, guys, let's just be conservative or realistic, and let's say it was 1 every other day, 3. In fact, let's even go less. Let's say you did 1 on Tuesday and 1 on Friday. So you've got 2 people in the week that you referred to take a look, that you just mentioned how cool this program was and that they should take a look at it. Well, guys, our coaches in here are doing such a phenomenal job. They are getting over 50% of the calls that they take to actually get on the program. Their closing percentage is exceptional, and it's just going to get better. But again, let's say that they're only at 37.5, so about 1 out of 3 people. And you refer 2 people in a week over, that turns into 3 sales in a month. Your check is $19.50. Guys, and I don't know how much more part-time you can get referring 2 people in a week and make $1,950. I'm going to tell you, I made $1,100 my first month with the company, and it lit a fire in me. I got so excited that I could think of nothing more than duplicating that the next month. Now, guys, whether you try to or not, people are going to recruit. They're going to come on as agents once they see this opportunity. So let's say it takes us a month, but we get 3 people to come on as an agent. So, guys, before we recruited, we were at the rank of agent. We are now, once we recruited 3 people, we have now got a promotion to supervisor. We get 4% on all the sales in our organization. But again, we're going to say each one of these 3 just refers 2 people. So they're not by any means going out and referring those 5 or those 10 like some people will. We pick up that 4% and our check now goes to $2,800. We start to get excited. Again, we start to talk to a few more people. Let's say it takes us another month or 2 to get 6 agents. To get 6 agents, each doing 2, that gives us a promotion to the rank of director. So at director, we not only now pick up 6%, but we pick up 2% on our second level. And in this example, I'm not even showing that we have people on our second level. But we're making just under $5,000 at $4,700. Guys, that's about $58,000 a year on a part-time job. So that's well over the average American income, and we're just scratching the surface. Guys, again, whether you try to or not, this whole process is going to start to duplicate in your organization. But again, being realistic, let's say that only 2 of these 6 actually do anything as far as referring agents. So 4 of them do nothing, but 2 of them go out and get their 6 because they want to become a director. So that actually turns into 12 people on our second level, and each one of them is only doing 2. Guys, we're now at 8,500, and I'm not going to try and get these numbers so big that they're unrealistic. But hopefully you realize onesies, twosies here and there, just by opening your mouth and talking to a few people and recruiting a small team, it generates income. $8,500, guys. That is a $102,000 a year income. As we go down the line, and this is not including bonus pools. Guys, don't forget it. If you make 3 sales in a month, which referring 2 people and we're only closing at 37%, you're going to make 3 sales. You're going to get several $1,000s more in bonus pool money. So again, let's just kind of duplicate this process. We have 12 people. Let's say only 4 of them actually recruit. 8 of them do nothing. So we have 4 people who got their 6. Each one of them just refers 2 people. Guys, we're at 8. That's a $10,000 a month raise. And we're at the executive director position. Now, guys, this is a director. This is a position that we need to hit in 6 months to get a portion of that partner pool. I'm going to tell you, we will have people come in here and do it in 2 and 3 and 4 months. You watch. Now, if you're an executive director, someone in your organization is going to stick their head up and do exactly what you're doing. They're going to build an organization just like that. And so they become an executive director. So in other words, they have their own branch. So they become their own executive director of their own branch. That means they rolled out from your branch. They have 42 agents just like you did in 3 levels. And each person is just doing 2. Again, guys, that income goes up so fast, and it ends up pretty soon you'll have 2 branches and 3 branches and 4 branches. That actually gave us, once we got one executive director underneath us, we got the promotion to managing executive. And guys, we're well on our way. We haven't made the change yet on here, but this top position is actually going to be called partner. We're going to take out the senior executive title and slide those 2 down and call the top one partner, because that's exactly what it's going to be. You're going to be taking apart in the entire, all the sales in the entire company. So, guys, if you're looking at this again for the first time, get involved and download numbers on here that you think you can hit. And I've had some people say, well, Jason, I don't want to put any agents in here. Hey, that's fine. Just go by your own. How many referrals can you make? Can you make 5 referrals in a week to the company? In other words, can you talk to one person a day who's willing to get their analysis run and get on the phone with one of our coaches? Guys, that's a $7,300 a month income, and just off of personal referrals. And so, guys, let me bounce right back to our PowerPoint here. Okay, what's the next steps? Guys, the first thing is getting involved, becoming an agent. It's $149 to become an agent. Get with the person who invited you on the phone. Tell them where you're at with that. Don't procrastinate. Your 6 months is going to start as soon as you get involved. Now, we do have a promotion running as well through the end of August that if you pay your $149 to become an agent, and you make a sale, or you make a sale within your first 30 days, not only will we pay you the commission, we're also going to refund your $149 back to you, okay? We do have a training call tomorrow night at the same time. We're going to go over some goal setting and some calls to action and go into those new exciting tools a little more in depth. And you'll get to hear from the owners on those calls as well. But again, guys, my name is Jason. I sure appreciate your time. We're right at an hour, so I'm gonna turn the time back over to Spence just to kind of end the call. Guys, I sure appreciate your time, and if you have any questions, please email us in at support@worthunlimited.com, and we'll look forward to talking to you tomorrow. Everybody have a great week.
Jason, we sure appreciate your presentation this evening. We're really excited about it, and we thank all of you for joining us. If you have any questions, please send your questions in to support@worthunlimited.com or call our toll-free number, and we'll be pleased to deal with that. Also, on the calls, you're more than welcome to ask questions through the meeting presentation. We'll respond to those throughout the call. Again, thank you and have a good evening.